Welcome to the Female VC Lab podcast. I have Tiana here today. Tiana, in one line, can you give me your name, your title, and the name of your fund?
Absolutely. My name is Tiana Laurence, and I'm the general partner of Laurence Innovation.
Wonderful. So, Tiana, what inspired you to become a venture capitalist or an investor?
Yeah, my dad handed me a book on equities when I was about 8 years old.
Oh, wow.
And I started reading about stocks and bonds and commodities.
Mhm.
And was really interested in real estate in my teens. And then came to a conclusion in my 20s that if I really wanted to build, because I was just waiting tables and stuff like that, if I really wanted to build up the kind of capital I needed in order to become an investor, I needed to learn how to start companies.
Oh,
And so I started building and failing companies in my 20s, finally sold one when I was 29, and
wow,
then started
congratulations.
investing. So
Wonderful. That's awesome. So, what is your investment thesis and what is the motivation behind your thesis?
yeah, so I invest in primarily pre-revenue companies.
Mm-hmm.
And I've been doing that for about 6 years, first as an angel, and then I set up my fund last year. And what I saw was that even the brightest VCs that did the best due diligence still couldn't pick winners, and that it was a numbers game. When a company is pre-revenue, they're 3 times as likely to fail.
Right.
And the upside's still good, it's 10 times. But
Mhm.
when you think about that, if you're thinking about like due diligence, for example, in an early stage company, everything they're going to send you is just stuff
Very
they've made
minimal,
up.
very
Yeah.
minimalistic. Yes, it's very pro forma, we'll put it that way. Very early in the game. Absolutely.
So what you're really investing in is the founder and
Mhm.
their ability to move forward. And what I have found both anecdotally as an entrepreneur myself, as an investor, and then I've gone out and found research that's like makes me think that this also is true, is that there's only a few characteristics that can help shift that needle about whether or not a company is going to be successful. They're not total determinants, but like it would be, does the person have integrity? Will that person deliver? Do they have this sort of like
Can
conscientiousness?
they
This
execute?
yeah,
100%
yeah.
important.
This drive that if they haven't done what they said they're going to do, they're going to keep on working at it. So that
Mhm.
conscientiousness is really important. It's
Mhm.
almost that obsessive compulsive need, but like
That's
channeled
true.
in the right direction. And intelligence, can they deal with the complexity of what they're trying to handle? Because you, especially as an early stage founder, you have your investors, you have your employees, you have your competitors, and then on top of that, you're trying to grow something and trying to
Right.
do something you haven't done before, and that's an
That's
incredibly hard
tough.
lift. It's really tough. My thesis, sorry, that was a long way to get to that,
No,
is that
that's great. I love it.
invest in a lot of companies, go early, give them a little bit of capital, see what they do with it, give them a little bit of more capital once they deliver.
Mhm.
And the other part is look for those 3 characteristics in your core founding team: intelligence, integrity, and conscientiousness.
Wonderful. Thank you for that.
Yeah.
So, what are you currently learning or listening to or reading these days?
I am preparing to expand my operations. So
Wonderful.
I'm just constantly reading about how that works, how to be able to automate some of the things that I want to do, like due diligence and dealing with type 2 error. Basically, it's a great investment, but it doesn't look like that initial gut reaction that you might have,
Mhm.
because those tend to be like undervalued founders, underrepresented areas. How do we both suss out like our own human bias so that it doesn't blind us to great opportunities and great innovation? So that's where I'm spending
That's
a lot
great.
of my time, is like trying to figure out that piece so that I can scale up operations and serve more entrepreneurs.
That's excellent. Yeah, due diligence is hard. We actually have a process for that ourselves as well that needs to
Yeah.
be automated. Just need
It's
to
it,
automate it. It's because we have a very rigorous one. So,
mhm. Yeah, it makes total sense, especially when a company is post revenue.
mhm.
Because then you got to go out and check What are these contracts? Have they figured
Yeah.
out their IP? Do they own it? Do they have anything unique? Where are the conflicts? Like getting in the closet and seeing
Well,
what's
and
hidden.
also like their investor base. You can
Oh,
see that as well. Who's
oh
invested,
yeah.
that, who's on their cap table. You can see all those things, which is important to know. Structurally, did they structure it properly? These are all important things to know.
Yeah, one of those core issues that I see often, because a lot of times I'm some of the first money into a startup, is valuation. How do they know what they're worth? And it's just all over the map. Yeah.
I'm in Silicon Valley. I'm 10 million. I'm in this place. I'm this million. It is if you have no revenues, it's harder to have the value, because also the mechanic that they use, or that's used normally, is the safe note, which has no valuation attached. So how do you know how much the value is? You're assuming you have a value, but you've given it no value.
Yeah.
In essence.
I basically created a modified Burkus method where you basically say, who's on there, what would their fair market be if they're pulling in a salary working, then discount it for risk. And then say, okay, what else do you have? Do you have an MVP? Do you have a working thing?
Do you have clients? Do you have users? Do you have, then you can go on, and then you can go on from there.
And the sign a
Burkus
dollar
Makers is really good.
Yeah, I think it's perfect. I think it's perfect for the pre-revenue company, because then you could say, okay, what do you have? What do you not have? And there's a place of negotiation where it's, instead of just something arbitrary that they pick because they read a blog that was written by somebody that was,
or they read a TechCrunch. This one did it, so I'm doing it.
Or they think that they can have the same kind of valuation as a company that's just totally different. Or I had one recently come to me with $10 million valuation, no business, not even a business model. They just wanted that based off of the team they were showing me on their deck. And I was like, yeah.
And this is a learning. It's a learning on the side of the founder, is to, when you're saying you're valued at that level, what do you really have to prove you're valued at that level? And you're really setting yourself up for later to be valued less, and thus you get a down round. So do you really want to do that to yourself? I think when you don't look at the mechanics of how that goes, like you got pre-seed and some pre-revenue, and you go up the stack later, somebody is going to be like, this value is wrong.
As an early investor, I'm incentivized to help them get it right, because the relationship's so long and no other investors want to want on the deal if it's overpriced. And if it's underpriced, then they're probably selling more equity than they should, and then they'll become disincentivized by the time it starts to get interesting.
Correct.
And I had a conversation this week with a startup that had $50,000 of revenue, recurring revenue coming in. They're trying to raise a round. They had just bootstrapped it. And
that's great.
Yeah, it was fantastic. And he was wanting to raise $1 million. And he was thinking he was going to sell like 17% of his company. And just as a rule of thumb, this isn't a hard and fast one, but don't sell more than 10. And with a company that's bringing in that much recurring revenue and has good client retention, there's no reason that you should be selling 17% for $1 million.
Right.
So
the economics of that didn't work. But see, like, I mean, really,
I could have just taken that and been like, this is sweet. I would go solve this whole thing. But then it was like, by the time he's like raising his third or fourth round, like
once he goes to Series B, he's out. And this happens to founders as well. That's fairly common, where it's okay, you got down the road, you made it, if you got to Series B, you're like one of the more successful founders, but then you find out that you basically gave your whole company away.
That's right. Yeah.
And then you're like, how am I not the CEO of the thing I created?
And so it would be short-sighted to take that quick win as an investor to shortchange the entrepreneur just because of not ignorance, but that's not what he's been specializing in.
They're naive. They just don't know. They're just a little naive.
They've been doing something else.
There's nothing wrong with it. Everybody was a first-time founder at some point. You know what I'm saying? If you founded something, you were first, and it was the first time you did that, you were a first-time founder. So you just don't certain things. But that's why having somebody like you on their side is super awesome. All right, Tiana, bonus question. In 2 years, when we're talking, how do you see venture capital or investing having evolved?
I think right now it's such an interesting time because next 2 years are going to be very interesting economically, globally.
Very true.
And so I throw that into the dynamic as well, not just like a regular 2 years in any cycle, but this is, I think, a once in a lifetime economic change. We're also seeing like China becoming more and more competitive, issuing out their own digital currency and doing all the global development with ports
Various
and
things
trains
they've
and
done.
stuff.
Yeah, a lot of infrastructure.
A lot of
infrastructure at all levels,
Absolutely.
like ports, trains, water, energy. We could go on and on about that.
Yeah. So as I think about how does the US think about what does it want to be doing economically, globally, and it's pulling out of the current situation, like the bill is going to be coming due economically for us based off of COVID, like we're pulling out of it, but now like all these businesses have gone under, but people have had a year to think about how to innovate and what are the new businesses going to be created. So I think right now there's going to be a ton of new startups coming out. I'm already seeing it. The other thing is, because I brought up all this stuff from the global perspective, is there's so much money being pumped into the economic systems. Like, was it 28%? I don't know exactly what the number was, but it's like all of 28% or something of all the capital that ever existed exists now. And so it's just everybody's fleeing these cash positions and putting it into things like real estate and equities and things like that. And it becomes a founder's market where they can go raise capital and they might not have a solid business plan. They might not have a product, a clear idea about what the product is. A little bit of that .com bubble feel where they got a .com, they raise some capital. So I think there'll be a little bit of a flavor of that, where you'll see valuations that don't exactly make sense as the number of VCs increases. And then you'll have another aspect of all the different sort of variations of WeFunder, GoFund, these sort of
the crowdfunding or alternative kind of platforms like that.
Yeah, that are going to be eating away at the traditional boutique venture capitalists.
Okay, so this is interesting because we do crowdfunding in our fund as well. But do you see that? I know the original vision of that was to replace that pre-seed round where you lie. Do you see that cannibalizing anything you're doing or no?
Yes and no. So one of the issues with doing a crowd fund is that you need to have a company, a product, a service that the general population can understand, see the value in, and you need to be able to distinguish yourself on that platform. So you end up spending more probably front loading your marketing of what you look like versus what you have. And so that takes time, that takes money. And my goal is to be the first 250K into a company that's getting to that MVP. And I think the companies that have a minimal viable product and at least a customer, then they're ready to go onto something that's crowdfunded, because then they could at least sell it. But I also think at that point, once they have a product and at least a paying customer, then they start becoming more interesting to other types of
investors, higher net worth individuals, potential like the potential seed fund people. Yeah, that's true.
Yeah.
That's true.
So from my perspective, I love technology. I don't mind geeking out and looking at something, and then have a good network of people as well. Like when I see something that I think is just tremendous, then I can pick up the phone and call somebody that has that more specific knowledge and say, does this make sense, and help foster up that entrepreneur so you can get to the MVP. So yes and no.
Interesting. All right. Thank you for that.
My pleasure.
So how do people contact you?
They can go to my website, just laurence.capital, and hit me up. I have an application online for startups.
Wonderful. Thank you so much, Tiana Laurence from Laurence Capital, for being our guest on the Female VC Lab podcast.
Thank you very much.